to the Google Tech Talk by David Leinweber about if you had everything computationally, where would you put it financially? I met David this winter at the Money Tech conference where he gave a talk, which I really enjoyed. And so and we worked together to bring him here to Google to tell you all about his topics. He's the Haas Fellow in Finance at the Haas School of Business at the UC Berkeley, and just started a new Center for Innovative Financial Technology, and where he especially focuses on how to extract the tradable information from the web, which is something basically interesting for us at Google too. And before that, he was a trader himself, managed several portfolios, and basically he started out with degree in physics and computer science from MIT, and there was one of the first people on the internet. So he's really been basically with that part of the technology world since the beginning. So David Leinweber.
It's great to be here. I think we started talking about this about 2 years ago. I was on a conference with Peter Weinberger, but Wolfgang really put it together. And my Berkeley colleague Hal Varian, who maybe we can't see the guys in the Silicon Valley side of the room anymore, also was instrumental in doing this. The talk is called "If You Had Everything Computationally Financially." This is really the first one that I'm doing as the head of the center at Berkeley. Just to give a little bit of background about why am I here. I did start out at MIT, and then I got a graduate degree at the school up the road, Harvard, that wanted to merge with MIT in the 30s and called the combination Harvard. Later, I founded a company called IAC that later became ITG, the Quantex product, an early algorithmic trading system. I didn't want to move back to New York. My wife is a Southern California girl and wanted to stay there. So I went to work for a quant manager called First Quadrant, where I became the managing director for equities. I ran $6 billion in 27 different quantitative strategies across 6 countries, both long and market neutral. Having sort of been bit by the entrepreneurial bug, I started a firm called Codexa in 1999, which was an internet information extraction firm. And we probably should have started it in 1997. Post-bubble, I got to be a visiting professor at Caltech, which I think is, better than hitting the streets, and have continued to work in the area about extracting information for financial purposes from the web. And over the last year, I've given a series of lectures as a guest speaker at Berkeley. And they invited me to start a new center there called the Center for Innovative Financial Technology. If you look at the Berkeley website, everything is innovative. I heard a rumor they wanted to change the name of the Operations Research to the Innovations Research Department, much to the dismay of the Operations Research people. The center has a website, which you were invited to go look at. They have the bear. The whole Go Bears thing is a little mystifying. At MIT, they have teams, the beavers, but you might not notice unless you were on one of them. At Cal, it's very different. This slide shows in a nutshell, well, I guess visually speaking, sort of 2 nutshells, what the center is about. We're interested in the activities at the intersection between finance and technology, finance and computer science, really, is the technology that matters for finance today. We have a mission statement given to us by the dean: conduct and facilitate innovative research and teaching on how new technologies impact global electronic markets investment strategies and the stability of the financial system. You can see that the research is over there on the left, the teaching on the right. Actually, the students are fabulous. The students are fabulous. And one thing I will do is, I mean, a lot of them would love to be interns, and at Google or other firms here. If you have interest, we could hook you up, as my daughter says. The areas of interest, and this is on the site in a sort of a longer form for the center, are Web 2.0 for finance and investing. The idea of aggregate molecular search, which we're going to talk a lot about today, using the semantic web, harnessing ideas from collective intelligence in a practical sense. There's one center, and I won't say where it is, that is about harnessing the ideas of collective intelligence and cooperative work that seems to consist of one guy. I don't think they're going to make a lot of progress. We're trying to recruit people, at a number of levels, at sponsors, sort of faculty affiliates, and just general kibitzers. And I'll give you instructions on how to sign up as a kibitzer. A lot of issues involving wired markets, algorithmic trading, quantitative plus investing, I would call it, because a lot of the information that you use is really not quantitative. A lot of it is textual in nature. The idea of intelligence amplification, human interfaces that allow people to play well with computers. And this sort of plays to one of the specialties at Berkeley, the idea of hardware for high-speed markets. One of my computer science colleagues, Dave Patterson, who here invented the RISC chip, says, parallelization is the wave of the future and always will be. It's been very hard to find real applications for parallel hardware, but they're building mini-core architectures, and they're very interested in sort of if you have a serious graphics problem, you get a graphics card. If you have a serious sound problem, you get a sound card. If you have a serious market analytics problem, you can't get a market analytics card, but if you could, what would it do? I guess is the way of saying that. And then there's the issues of technology and market stability. A lot of people think that technology is a destabilizing influence in market, and there are some examples. The 87 crash was exacerbated by the use of portfolio insurance, which was developed by the firm LOR, Leland O'Brien Rubenstein. L, O, and R are all on the faculty at Berkeley, and really don't want to do it again or see anybody else do it again. So I think those issues are, and there's not as much hard engineering in there as there in some of the others, but it's an important topic. Getting to the meat of this, if you had everything computationally, where would you put it financially? The origins of this talk come from the 30th anniversary edition of the Journal of Portfolio Management, which had a huge number of papers and virtually nothing about technology. So I'd written for them over the years. I called up the editor, Frank Fibosi, and I said, hey, Frank, what's with the technology? Frank, if you know, is the mother lode of the finance section of the bookstore. It's like Fibosi and everybody else. And he gets there not by writing prolifically, by suckering other people into writing prolifically. So he did what he does so well and suckered me into writing one. The summary of that article was sort of to look back at the greatest financial technology hits. Electronic market data, computerized data storage and analysis, electronic execution systems, and then looking forward. In algos, in intelligence amplification and visualization, and in finding alpha in textual and internet information, which is the focus today. One thing about the investment business is that people go, oh, it's sort of a niche. In some senses, maybe in algos executing over 43 different dark pools, it is kind of a niche. But in terms of finding research or keeping track of what's going on in the business, the kind of stuff that you would read about as opposed to trying to process high-speed data, it really is kind of the aggregate of all business. The institutional investor All America research team consists of people who specialize in industries, banks, buildings, chemicals, energy, engineering, consumers. And they have the same interests that the people working at these companies would have. So you can really think of at least in the sense of more traditional securities analysis as opposed to micro-level market structure issues, as the investment research industry as the union of all other businesses. There's a nice picture. This is one of my favorite graphics. It started out as the tree map for computer science purposes at Ben Schneiderman's lab, University of Maryland, but it's got some traction over the years at Smart Money, a Dow Jones company that allows you to sort of take a view of the market, and you can see that clearly this is what business is in the United States and the world. I'm going to digress a little bit to give a short history of market information technology. I find it's easy, especially, I mean, some people are not, deep. I know some of you guys have been doing this your whole lives. But it's easier to understand what's going on technologically sometimes if you look at something simpler. We have a Prius. You open up the hood of the Prius, I have no idea what's going on underneath there. I can barely identify the parts. But if you look at, say, a 57 Chevy, or even a 67 Chevy, all the moving parts are clearly identifiable. So sometimes understanding where technology came from, it makes it easier to understand. In 1792, the New York Stock Exchange consisted of a bunch of guys hanging out by the buttonwood tree, yelling at each other. This was market dissemination back then. The first big technological advance was 1794, moving indoors so the market could operate on days when it rained or was cold. Information dissemination and trade execution were mostly by shouting at each other. You had to show up at the market. There was no such thing as calling your broker. The big change, the big advance was telegraphy. And this wasn't just really in the stock market. Telegraphy was the wonder of the age. This was the first time in human history that you could send a message over the horizon instantaneously. This was bigger in its day than the web was when it first came up. And we were kind of used to telephones. We were used to radio. We were used to television. This was a fabulous thing. Over here, you'll notice, where's my little... Yeah, I was just going to point that out. The speed, I don't know. I mean, it's the speed of light times about 1.5. Maybe they knew something we didn't know. There's a fabulous book on this called The Victorian Internet, about the impact of the telegraph on society, which really mirrors a lot of what we see happening in finance. The telegraphy caught on in a huge way on Wall Street. I mean, here we see it meant you didn't have to show up at the market in order to trade. This is a trader strapped a telegraph to his arm. Lots of guys did this. It was sort of the 19th century BlackBerry. You can appreciate that's the way you use a telegraph. You learn Morse code. I knew Morse code when I was a Cub Scout. Don't give me a quiz, but you can appreciate the impact of telegraphy by a pair of before and after photos. This is the neighborhood in the vicinity of the New York Stock Exchange shortly before the introduction of telegraphy, and this is what it looked like after wires darkened the sky a few years later. As Rob Almgren, the author of, as he claims, the most cited, least read paper in algorithmic trading over here, points out, you had to know Morse code, which a lot of people really didn't want to do. Tom Edison, the ticker tape, eliminated that requirement in 1870. It's an interesting story, but I'll tell it some other time. This created, in addition to freeing you from not having to know Morse code, this also gave you a record of prices. You could begin to study this, and this created sort of an information explosion of its own, where you see people saving the tapes and studying them. There were other sort of lesser technological advances, quote boards, where people would flip little signs like those things you see at the railroad stations. They would go behind, and you could look up and see what was going on. The ticker tape machines got bigger, better, and faster. People introduced telephones, which had another set of problems before the whole console industry arose. better, paper. You can see the little flip signs, people running around, a lot of paper. It was getting pretty overwhelming by the 60s, especially when individuals started trading stocks with all these little 100-share orders. So the exchange got its first computer. Here's the first nerd on Wall Street, I guess. I mean, he actually is the president of the exchange and probably didn't go. This was the only time he touched the computer, would be my guess. But in 1966. And there's a number of other talks on the subject of what they did with it. I want to get, because we have limited time, I want to get into what people are doing now, really, and how that has changed things. The disintermediation of execution is a key piece. The system, the DOT, handling these small orders. It's come to the point where people could boot their broker, so you didn't have to get on the phone, and the brokers wanted to boot the customers as well. E-Trade has had a classic series of ads with the baby spinning up on the keyboard after he buys stock, being the latest. You could probably write a market history just on their ads. I mean, this disintermediation now has led to stock exchanges themselves becoming an endangered species. The industry standard published a cover, Stock Exchanges, RIP, in 1999. The exchanges are still here. They're changing, and the floors are much smaller or gone. I understand the industry standard isn't, but maybe back as a website. Another pair of before and after photos that give you a feel for what happened in the markets technologically. This is the London Stock Exchange, the day before the Big Bang, the introduction of electronic trading in 1986. This is what it looks like the day after, and I believe it's a nightclub now. This has gone on. Now on the floor of the New York Stock Exchange, you'll see people using handhelds to access electronic systems, and really technology repeats itself. We see the same patterns over and over and over again. There's of course a lot of activity going on in the algo space. These execution systems evolved from 100-share convenience to really the mainstream. They've taken over the block market. They've taken over virtually all of the execution in U.S. equities, 95+%, and it's growing rapidly in others. One of the things about technology is that the early adopters tend to do fairly well. It's a good idea to see things coming, and I think in many ways, as far as non-quantitative, I mean, we've been talking about prices and executions. I think that the early adopters are the people maybe here and the people who are going to be buying things from you. One was Fischer Black, noted options maven and pioneer algo trader, inventor of the Black-Scholes model, would have won the Nobel Prize had he lived as long as Scholes. Scholes is still alive. His line was, markets look much more efficient from the banks of the Charles than from the banks of the Hudson, I think after he moved from MIT to Goldman. Jim Simons, founder of Renaissance Technology, a mathematician, very kind of the sphinx of quantitative finance. They don't talk much about what they do, but he does show up on the list of the most highly paid people in the world, taking home, 1.6, $2.6 billion. And it's all computerized trading. David Shaw, who I met years ago when he was a computer science professor at Columbia, is now Wall Street's king quant. He went from Columbia to Morgan Stanley. Morgan Stanley's automated trading group. The last paper he published in finance was something about hooking Unix machines to market data feeds. Then he realized, what the heck am I doing? Why tell anybody else how to do this? And founded the firm that bears his name. He's now sort of decided he has enough money and he does computational biochemistry and as his own venture capitalist. There's another interesting firm is Automatic Trading Desk. This did algorithmic market making. They have a great website, AT Desk. Dave Whitcomb describes it as playing NASDAQ like a piano. Dave Whitcomb, by the way, is a member of the board of our center and very supportive. We're really glad to have him involved. And what's next? What's next? We've talked about the people who were, sort of getting ahead of the curve back in the 80s. The exploitation of quantitative information was and remains a great success. None of these guys are flying commercial. The prices and the market data convey a great deal of information, but they don't convey all the information. Where to look for new information advantages. And this is a little bit of a digression, but I love this picture. I took this in an educational supplies store. These are plastic pennies, which they're selling to kids so you can teach them how to make change. 100 pennies, $4.75. Who buys these, But I mean, what Simons and and Black and David look for, maybe not the $4.75 bag of pennies, but the $1.05 bag of pennies, the $1.02 bag of pennies, the 98-cent bag of pennies, and you're a buyer or so, and you just all you got to do is get within what it costs you to buy or sell the pennies, and then you can make some. And market making, electronic market making, is sort of like that. So it's not just this funny little gag, though I have to admit I go in and see if they've moved them, and occasionally they restock. Where does alpha come from? I mean, we've talked a little bit about this. Alpha is outperformance in an investment strategy, and if you were to ask a bunch of financial economists, where does alpha come from? Say in the 90s, you could put together a crowd that would say it's a trick question. There is no alpha. Markets are strong form efficient. It's a waste of your time. It's a waste of your time. Don't bother me. The joke form of these comments are the economist walking down the street, he sees a $100 bill, walks right over it. His friend says, "Why didn't you pick up the $100 bill?" The economist says, "If it was real, somebody would have already picked it up." The fallacy really is that somebody has to be the first one to pick it up. Andy Lowe, who teaches up at MIT, wrote a nice essay where he sort of not only admits to the possibility of alpha, but says that it's the economic rent that accrues to the competitive advantage of superior information, superior technology, and financial innovation. In the internet age, there is a lot of superior information and superior technology to use. We are, as that tech sage. I got Scholes, I got Andy Lowe, I got them all. I got Dilbert or Dogbert. Information is gushing toward your brain like a fire hose in a teacup. What does that mean? There is a fire hose of information with potential alpha in it. There are the electronic versions of mainstream news. There are disintermediated news. You can be your own reporter, just like you can be your own broker. There's electronic access to primary sources. If you read what's in the paper, a lot of the in SEC filing, in court documents released today, you don't have to wait for somebody to read that for you. And then there are new media, creatures of the net. Whisper numbers are an example, various social websites, some more valuable than others. The Wall Street is kind of a small, concentrated place, at least physically, and the internet is fairly large. So this creates a big challenge. And how do you get to this stuff? And it's not all public information. Financial information is what, a $25 billion industry, I think, maybe 30. People will pay a lot for high quality information from Reuters, Thomson, from others, and I think they have the same problem. There's more of it than people know what to do with, and I think it's good for companies like Google who are great at taking tools that manage a lot of information to be able to sort of hook into a private sources of information, either proprietary things that people will pay for, or stuff that's generated inside that you don't want to let out. Everything happens a lot faster. There's a great need for technology to do this. Time isn't quite what it used to be, nor is this sort of mashup version of a Dali painting, the persistence of memory. This is a remarkable pair of slides that shows that how the web has changed the process by which information is impounded in prices. These are from my friend Bob Buttman, who used to work for the Deus Group. Now he's at Thomson Quantitative. This is earnings surprises. Everyone knows what an earnings surprise is? It's when a company does better than expected. These are the earnings surprises. The web was around, but it was guys at CERN. It was, nobody was really using it for anything. And then in the pre-web period, what we've done, we've got an event study of the strong positive earnings surprises and the strong negative earnings surprises, and just sort of the universe here. And this is trading days over here on the bottom. Look at 20 days. I mean, this is people, the information, and the nice thing about an earnings surprise is they announce it at a particular time. You know exactly when it happened, and if it's good news or bad news, there's really no issue of interpreting it. So it's a sort of a perfect one for you. Look, you see over here, we're looking at 2 weeks. 10 trading days. I mean, guys are taking Barron's home and reading it on the porch out in Greenwich on the weekend, and coming in on Monday and going, well, maybe we should buy a little of this. And across the street, somebody's reading a different page of Barron's and going, well, maybe we should sell them a little. And you could wait a week and still pick up most of the advantage. Now, watch what happens to these curves post-web era. Amazing. Amazing. It's the same information. Reaction time is now minutes to hours. And if I made a newer one, I think we'd probably see these would just look like vertical lines. The earnings surprises are pretty simple. They're an old form of information. What about the text frontier, finding alpha on the web in other forms? I alluded to the democratization and disinformation of information. Back in the old days, if you wanted to get news, you had to get it from these ace reporters like Jimmy and Lois. You really don't need them for thought pieces. I think that's the future of reporting. But for a lot of standard type of news, you can really do it yourself. They've been disintermediated. Does news move markets? We certainly think it does. If you watch, certainly the first break of an unexpected story will move a market. The mainstream vendors have tried to address this. There were some product announcements for Algo feeds from Reuters and from Dow Jones, moving the technology from into the semantic web era. You see a lot of tagging, some strategic partnerships and acquisitions on both companies' parts. Little companies like ClearForest, Corpora, Ravenpack. This stuff is not cheap. It's about $100,000 a month. Does one size fit? There are a lot of questions. Does one size fit all, really? And does it get arbed away a lot rapidly? There's the Reuters one and the Dow Jones one. I think the Reuters people and the Dow Jones people have come up from Midtown. So there you go. I'd like to show you an academic piece that talks about how you might use this. That shows the what's under the hood, essentially. This is again older. This was reported in Barron's in 2001. Can computerized language analysis predict the market? If the answer was no, it wouldn't be in the story. The thing was called eAnalyst, and what they did, everybody knows what a language model is. Basically, the statistics of a piece of text. Sort of you get rid of the thes, the buts, and everything, and then you look at the most frequently occurring words, next most frequently occurring words. That's a unigram model, and you can look at word pairs, and so on. So they would estimate a language model. What they did was they took stock prices, and they did this for about 125 stocks, and they would do a piecewise regression. They would break them into plunges, flat areas, and surge. Oh, there's a plunge. There's a surge. And they would, for the in-sample period, they would collect the news that they could harvest over the web, preceding the plunges or the surges. So they were looking, for example, at Microsoft. They did this in a number of ways. They would look at individual stocks, they would look at sectors, they would look for all stocks, and then they would look at sort of do the Bayesian thing, and given a story that matches a certain language model, what happens to the stock? So they did a fairly, and this is one of the characteristic things of research in this area, is that oftentimes the computer science people do fairly boneheaded things financially, and the financial people do fairly boneheaded things in a computer science sense. This is an example of a boneheaded financial thing, but they did a trading simulation where when the story occurred, they would match it to the plunge and surge language models. They ran it for 40 days on 100 stocks. And if they got a match on the plus side, they would go long and close out the position at the end of the day. And if they got a match on the other side, they would go short and close out at the end of the day on $10,000 on each trade. So they're not comparing it to buy and hold, which is the boneheaded aspect of this. And you could just be generating a lot of trading. What they did instead was compare to a randomization test, where when the story occurred, instead of looking at what the model told you to do, you just flipped a coin. So they made some profits. They made a cumulative profit of $21,000, and the average was it should be on the slide here, was an $8,000 loss. So that was a highly significant result. And you're not going to see this kind of thing in a mutual fund prospectus. It's a very odd way of reporting, but that's what they did. This is another interesting piece of research from a fellow down at UT Austin, who I think is now visiting at MIT, Tetlock. He was looking at news also and evaluating sentiment on a one-day horizon. He took Wall Street Journal and Dow Jones news stories for a 20-year period and fed them into something called the General Inquirer, which is a fun piece of software to play with. This has been developed over 20 years with NSF and the Australian National Research Council funding the bill. It was a PL1 on IBM mainframes, a language that I'm somewhat embarrassed to admit that I really know a lot about. You can play with it yourself at the website. And what Tetlock did, it characterizes text. It's been a PhD thesis machine. There are lots of ways of deciding, lots of characteristics of documents. And when you think about this, I mean, some of these are pretty obvious. I mean, if you had a bunch of if you wanted to build a machine to distinguish stories about motorcycles from stories about cooking, the language model, I mean, the word torque is not going to occur in many recipes. The word tablespoon and braise is not going to occur in many stories about new blazing hogs. So. And people keep doing these things. I mean, just think about deciding what language something is. That's pretty easy. But let me show you a little bit of how this works. You can go to the website and type in something, and it'll show you how it processes it. So I typed in this is I'm really looking forward to lunch. This is fun, but getting long. It breaks it apart. It stems the words, really becomes real, looking becomes look, and so on. It's got all these modules. Then it categorizes them, and you can see, fun is a positive. You can see all these PhD theses. I think they started out with, is this working? They started out with just positive and negative, or pos and neg, but people keep adding using different linguistic theories. Fun turns out to be a positive in many ways. It's pleasurable, lunch is food, and so on. It's categorizing them in many different dimensions. This is the top of the 1,046 word list on positive that Tetlock used to have sentiment. Able, abundance, abundant, acceptable, accommodate, accomplish, accord, accurate, lots of good, achievement. Lots of good things. This is the top of negative, a little larger set, 1,165 words. Abandoned, abnormal, abrupt, absurd, accident, abyss. I mean, imagine abyss occurring in a business story. It really can't be any good. Afflict, affliction, aggravate, aggravation. Abyss, though, I think gets extra points. And then what he did was he categorized this is similar in many ways to the analyst thing. He categorized the stories. This is the event study. This is the time of the story. And these are the positive stories, and these are the negative. I mean, you see, there's actually not that much going on. I mean, you get a little bit of juice from here, and this is when the story occurs. So this is when you could trade, and you get a little bit of juice. But in fairness, and I did talk to some of this is pre-event information leakage, but in fairness, a lot of this is Me Too stories. A lot of this would say, the stock went up and everybody was happy. That's a positive story. A lot of stories referring to other stories. So, it suggests a line of research, which we actually are undertaking at Berkeley. One of the companies is giving us a lot of data. The other one I haven't asked yet. I will be. So we're gonna try to see if we can shed some light on this. The distribution of annual trading returns, and again, it was a little on the boneheaded side. There were no transaction costs, so the most frequently occurring is zero, but they skew positive. So even with this, there's something, which is what you'd expect from looking at those event charts. Again, he's got his summary of the stuff. There are many forms of news, besides these mainstream media stories. There's a lot of disintermediated news to look at that really are the primary sources, and I think that would be a very different chart. The specialized industry media, the international, some of the private news disseminated by the XML, which is a research consortium, and then of course the government agencies. The SEC is the mother lode of government information about companies. Companies show up, and there are 12 federal district bankruptcy courts. Companies show up. Usually, it's a bad sign the first time they show up. It could, subsequently, it could be good or bad, but they're not always there. The SEC looks at all the companies all the time, and they're reputable. If you lied to the SEC, you may find yourself doing the perp walk. That was, I guess, your job was to send the guys with the cuffs. They're very deep, and it's becoming more tractable as they've become sort of fans of XML. The idea of the deep web. I mean, you type in the name of a public company, even public company followed by stock, and the stuff doesn't show up anywhere near the top of a search engine result because it's in the deep web. To get to the interested, there are thousands of items, probably tens of thousands, maybe hundreds of thousands of items. There are 300 different types of SEC filings about General Electric, but you got to log in and ask for them. It's a database. You have to make a query, so you need something to access that information. You don't need a password. It's public, but there are others where you do. And the SEC was really embarrassing for a long time. They hired that powerhouse of information technology, TRW, good guys to go to if you want to buy a satellite, not so hot a place to buy software. It was really like a 1978 vintage system. I mean, I think they'd done Sabre. It was all just plain text. I mean, it was this is plain old ugly Edgar. Just a bunch of guys typing stuff. Very little tagging. They didn't separate sections. You had the date. You had the company name. You had the filing type. You had something called the central index key, which was kind of in lieu of symbol, and that was about it. I got in trouble for writing an article criticizing this in the Financial Times, and they even delayed it 24 hours on the public website. They would provide it to the resellers who would kind of do cleanup on this stuff, tag it by whether the file. There's 9 different subtypes for the 8K filings, for example, but they delayed it. And I submitted an article called "If Amazon.com .com ran sec.gov to the FT, and somewhere between the time that they published the article and the submission, the SEC did take that 24-hour delay, so you could actually get it. And the FT saw this as my fault. So I have to sort of sneak around when I go there. We're gonna the new XML Hip Edgar, the new guy. I mean, I find myself amazed. I'm actually saying something good about a member of the Bush administration, but the new guy, Chris Cox, has finally gotten rid of TRW. He put it out for bids. People have been trying to do this kind of stuff for a long time. There were some prototypes. NASDAQ did some prototypes. I think Price Waterhouse did some prototypes. But he's making it happen. He's tagging the sections. A lot of the stuff in SEC filings is like the tags underneath these chairs. You know, it's inflammatory language. You know, abyss, but it doesn't mean anything. So it depends where it occurs in the document. And he is chopping it up, and you can see this. He actually went and gave the keynote address at the xbrl.org. You can fake this stuff. You can write your own programs. My colleague Jake Sisk here did a lot of work with me, both academic and commercial, in slicing these things up and looking at the relationships between documents, sort of the linkage analysis. And I have an example here. The idea of looking at how a document relates to another document, and in the SEC, how another company relates to another company, gives you a lot of information. That basically we're exploiting the information and relationships between information entities as well as the information contained in those entities. We are at Google, so I do have to say, what a concept! Hey, this might actually catch on. In the SEC context, you can look at the 10Ks and take out the filing 21s. I mean, these are sort of the kind of the in links and the out link, essentially, will tell you what the subsidiary relationships are between various companies. It's a multi-step process, very tedious. This stuff is written by lawyers and accountants with word processors. The due case statement had, 27 cases when last cited. So you can ask the question, do the number and type of filings made by a complex company, like say Enron being the poster child for a complex company, how do they compare with other firms? This really, I mean, we talked a little bit about the sort of the analogs to PageRank. This is one of the oldest forms of electronic signal analysis. This is traffic analysis. Goes back to World War II. If you're Eisenhower or Patton, I think Patton was listening to Rommel, and you see a little noise from Rommel, how you doing? I'm okay. What's up? What's for dinner? Maybe that's just an ordinary day. But when all of a sudden you hear a lot of activity about petrol supplies and ammunition supplies, the message traffic goes up, something might be happening, and you can elaborate when things go from in the clear to in code. That's a sign of trouble. So this is sort of a traffic analysis. What we did was we found companies comparable to Enron. We looked in the same SIC code, got all the Edgar filings associated with those companies, and then found the related entities and counted their the total filings. Enron, it turns out, is a massive outlier on both scales. It's more. This is the raw data. It's particularly dramatic when you plot it two-dimensionally. I mean, this is after the fact, but some of our research indicates that this kind of thing, and this is obviously, I mean, this is aggregate. It's kind of, think of molecular in the extreme. I mean, we're looking at the relationships among a lot of different things. There are other examples in SEC filings that are much simpler than this. One is the 8Ks. There's, I think, the current report. There's 9 different reasons why you file one of those. Some of them are change of management, change in ownership, change of auditor. Usually if the auditor leaves, that's kind of an interesting thing. When Arthur Andersen went out because of this Enron stuff, everybody had to change. Everybody who was using Arthur Andersen had to change auditors, so there was no news there. The resignation of a director. Directors come, directors go. So one of these really, and this is an example of an XML tag that my friend Cox is putting on at the SEC. Directors come and go, they retire. But suppose there's 11 people on the board and you see 15 resignations in the space of 2 months. That might be an abyss. Something's going on here. People, the directors saw what was going on. They all left. They got some new directors. The new directors said, "Oh my God," and headed for the door. So again, I think the search results are very much atomic now. You get individual documents, but if you kind of look at the molecular structure between them, the relationships, and it's very domain specific. You need to be able to construct something that will look persistently. You don't want to be searching for it manually, and specify what's of interest. Sometimes it's the one example I gave you would be of interest really for all companies. Some are specific to certain industries. My colleague, Mr. Passarella here, has some examples. I'll show you later on for that. Other things, programming tools. I mean, this is a little bit of the idea of intelligence amplification. There's 2 gig of text being dropped at the SEC site every day. Which ones are interesting? A lot of them are just totally routine. Diffing the footnotes, extracting the footnotes from the 10Qs and the 10Ks, and using diff. I mean, I know some of you are programmers. Diffing will tell you what's new, what's gone, and what's different. And the footnotes tend to be, if you look at these things, you extract the footnotes, which again at this point is not easy, and then you look at them, you see they tend to be the same quarter after quarter after quarter after quarter. But when there's a lot of new stuff, it's hard. You've definitely found smoke. Sometimes it's hard to tell whether you found fire or positive fire. I don't know what's the opposite of fire. But that example, certainly when there was a huge, and these were just, taken by, at a particular period. We looked at the biggest differences, and certainly something happened to FMC after that one showed up. Another example, real networks, a big, big footnote, a lot of smoke, and there's followed immediately by a big move in the stock. Energy trading, I don't know what company PCG is. Again, as soon as that showed up, and again, we're looking at scales of days. These are not things that happen in milliseconds. It takes a while to digest. So this is, you can think of this as sort of the intelligence amplification, letting the machine find what's interesting for you. Here's another example of exploiting structure in SEC filings. This is again some work that Jake and I did. The idea of director board membership, concentration and returns. There is better governance associated with better stock performance. CalPERS and a number of activist investors believe so, and so there's a lot of interest in this, and it kind of makes a certain amount of sense. If the board is paying attention to the company, that is a good thing. If the board is familiar with the issues that the company is facing, that's a good thing. Turnover and tenure. If the board has skin in the game, that's probably a good thing too. And you can extract a lot of this from the SEC filings. Again, it's somewhat tedious, but it can be done. So let's just look at one component here. This is a board membership concentration. We look at the total number of boards the directors are on divided by the number of directors. So if they're on fewer boards, the lower numbers would be associated with higher returns is our expectation. That's our hypothesis. So we got the board concentrations in April 2003, and we looked at returns by quintiles and deciles. And this is the result. This is like the Heidi Klum of bar charts. I mean, they just don't get looking better than this. This is the kind of thing when you see this bar chart, you think maybe you're plotting the row numbers. You did something wrong. But when you break it into deciles, you see that it's not quite as perfect as it seems. I have another little example. I think then we're closing up. Another one looking at sentiment in corporate annual reports. This is a fellow Feng Li at the University of Michigan. Some recent working papers. he did a sentiment analysis, sort of along the lines of the general Inquirer thing, which is acres of software, millions of lines written over 20 years across multiple continents. He did something much simpler. He didn't apply to news stories. He looked at the MD&A, the management discussion in the annual report, the 10K. And he ranked them for risk sentiment. None of this general Inquirer for him. He counted 6 words. Risk, risks, risky, uncertain, uncertainty, and uncertainties. Again, think how much the CEO doesn't want to say this stuff. I mean, it's not as bad as Abyss, but it's not good. So he ranks them by quintile, and lo and behold, you see, the more often they say this, the worse they do. And then he runs a trading simulation, by year, and these are all, except for one, it's positive every year. So that's, there's something there. I'll give you the paper. It's long short. It's long short. There's never invite a professor to come be your guest. You guys have a fabulous thing that I just love. Something you've done in Google Finance. That it's a sort of a microscope for looking at a micro level how information is impounded in prices. This is an example of a strong form efficiency. This would, here's the news, the price gapped, you couldn't do anything, the dollar bill, the $100 bill was a fake, you couldn't pick it up, so just keep walking. Then looking at another case, but they're not all like this. This is an example. I occasionally look at the big movers and try to track them back. We have a student who's working on some of this now. Here's an example from the end of 2006. Sort of a medium cap biotech stock, Exsentia, that was up 57% on the day. And over here are the stories. Well, there's no stories here. 57%, no stories. What happened? Is this insider trading? Could be. We don't know. But you can sort of track it down. A month earlier, if you do some research, you would find that in the Journal of the National Cancer Institute, there was a report on a clinical trial of a cancer vaccine made by Exsentia that was very successful. They don't mention Exsentia Biopharmaceuticals, but they mention the compound, and it was public information that it was made by Exsentia. Sort of the idea of meta-knowledge in the AI world, and kind of having people who know what they're doing. The news in that report was really, quite good. There was no abyss here. Specific immune response associated with dramatic and highly statistically significant increase in disease-free survival. Sounds good to me. The first formal demonstration of a clinical benefit associated with the use of a human cancer vaccine. Sounds even better. Surprised the stock is only up 57%. There were some posters who talked about it, and they did actually mention the company. This is and where it started, the primary source, and you could have known that to look here too. All you had to do was, if you're a health analyst, if you're one of the all-America team, this is the kind of stuff those people do. They know that this is happening at a clinic in Navarra, Spain, 13 months. And, even though it sounds great that you could, the stock is up 57% if you do it in the morning, you can't buy that much stock in the morning. You can buy a lot of stock over 13 months. The market cap of the company was a few $100 million. So you might have been able to make, million, two, something like that. But if you start accumulating the stock, I don't think this particular stock had options, but I mean, this becomes, as opposed to a nice portfolio event, this is the stuff that, gets you on the heroes list. The disintermediated news, what caused the stock to move on that day, on the 19th, was a Business Wire press release that mentioned both the company, the stock, and the compound. And the reason it didn't show up on Google was that I don't believe you guys were carrying Business Wire at the time. I think you do now. I think Business Wire wanted you to pay them, and then they changed their mind. So now it is there. But you had to go to the other sources, to Yahoo Finance, I believe, did pay them, so you could find it there. And there was some time. I mean, there's the press release is here, and you had 45 minutes or so to ride this up. So if you're trading for your own account, this is pretty good. The mainstream media had a story at 2:24 that said the stock was up. They kind of reacted to it. The other brand of mainstream media, I'm going to get rid of that because they're here. They didn't report on it. So and there's some lessons here. If you're a health analyst, and there are thousands, many tens of thousands of ongoing trials at hundreds of centers around the world, and the news dissemination process can be very slow. The news does not always mention the company, but it's public information, which chemical is being tested where, and tying it to the companies. Some of the key concepts, I think, in everything that I've shown you so far are the idea of persistent search, disintermediation. Going to primary sources, going to SEC, going to where trials are going on. Don't wait for the reporters to find it for you. The idea of going into the deep web, database access. You have to log into a lot of this stuff, and in particular, and I would expand on that, is how do you make money from this? I mean, I know Google would actually like to make even more money than they make. Coming from the University of California, which is $15 billion in the hole, the idea of making money sounds pretty good to me. The free bus now costs $1. Is the idea of providing hooks into people are spending billions, 25, 30 billion on financial information. You can rent them the adapter so you can let these tools look at proprietary information. You have research departments that consist of thousands of people. How do you digest their stuff? Your own internal. I think like those little the yellow box and the blue box, the Google Blades. I don't know if you still sell them. I got my client to buy one years ago for searching their own internal stuff. But that was just all words. Exploiting the semantic web, tagging things. Some stuff comes in tags, some stuff can be tagged at its origin. Moving to the molecular view, which we've had a number of examples, is really far more important than the atomic view. Principles of electronic intelligence, both the old ones, traffic analysis and NLP. And again, if you want to, it's like I showed the old pictures of the markets. If you read the history of the electronic warfare going back to World War II, you get the basics of this. And then, apply there's some human-computer interface issues. Overview, filter, alert, drill down to detail, sort of the Schneiderman mantra. There has been a lot of progress, I think, that we've seen. Here's a nice example using Yahoo Pipes from my friend Rob Passarella here. What he was doing was he thought that the Ratatouille game, which was being issued by kind of a medium-sized game company, might not exactly be a huge hit. You never know, but it's about a cooking rat, and most of the people who play video games would rather shoot the rat. So it's not a slam dunk. So he built a persistent agent to track the pricing on these things even before it came out, and found that because people were looking at it, and if you go, no one's going to buy this game. I don't get to shoot the rat. So and it was dropping like a rock, and he made the call that things were not looking good, and the stock dropped from like 15-20% in a matter of days after this. And this was persistent searching of Amazon, I think, right? Yeah.
A couple things, but you can see later on is that last one you got there is they had to actually close 2 studios because the revenue expected from that title did not come through.
Who ever thought a game about a cooking rat? But anyway, I like the rat, but. There's a lot of stuff coming out of your labs as well of similar flavor tools that you can use for building these persistent agents, these aggregating agents. Some of the alternative views. I mean, you've got this thing. I mean, I talked about trends. The 8Ks. You begin to see pieces of that. Some of the idea of directed search. A lot of this is you don't really want to go everywhere. You don't want to scrape the, what is the web now? 1.5 trillion pages or something. Many of them are just, guys in Albania typing stuff, after 3 vodkas sitting around in their underwear. And, that's not particularly relevant, I guess, unless you're in the Albanian vodka business. So you want to look at particular places. You want to extract particular pieces of information. And then deliver it, again, in sort of a human sensible way. The quants will probably want to take this and process it and try to do statistics and so on. But these RSS integrators that I use one from you guys allow you really to be in multiple places at once persistently. I give these talks to kind of mixed audiences. I have a lot of financial people who think computer science is writing an Excel macro. There's a lot more to that, and I urge them to read something like the Manning and Schutz book. There's another one on information retrieval as well. The computer people, you see things like what we saw with the e-analyst, some of these boneheaded comparisons of how am I doing by comparing it to a coin toss. People don't toss coins to decide whether to buy or sell a stock. People compare it to an index fund. So compare it to an index fund in the basics of that. I have my traditional semi-mandatory, semi-inspirational closing quotation. The progress may have been all right once, but it's gone on far too long from Ogden Nash. And a lot of the stuff is not going to be totally smooth. As with any new technology, we need to expect errors. We will expect surprises. We will expect some strange innovations like the Convair flying car, which had its, I think it's only 2 flights down in my old neighborhood near Santa Monica Airport. An emergency landing on Ocean Park Boulevard sheared off the wings. So they decided maybe the 3rd flight was not something they wanted to do. But ultimately, we've seen success. I mean, we're not buried in wires anymore. We're not buried in telephones, and there are ways out of this. We would love to have people participate in the center. There's if you go to the website, I've got cards with it on there, and it's all over the place here. And I think we've been around long enough that if you Google SIFT Berkeley, we actually do come up. But there's a collaboration area where you can just sort of sign up. I think some of you are on here. A lot of them are, anonymous, but I mean, we have a lot of ongoing discussions. So, kibitzers are most welcome. I only have one guy who's trying to sell Viagra, and I booted him out. I'm going to do a formal poll or an informal poll here. I'm doing a book that's coming out at the end of the year called Nerds on Wall Street, and I'm involved in a discussion with my publisher about the cover. We have cover proposal 1. There's the human trader and the robot trader, the algo trader. Buy, sell, beer, TV, sex, car, holiday. And then they had this alternate one with the robot wearing the glasses. Show of hands, who likes the one on the left? Who likes the one on the right? Really? Okay, well, I like the one on the left. So far, anyway, that's the one. Now we are about ready. I know I'm between you and lunch. This is a fabulous lunch spot in my hometown, Los Angeles. For the photography buffs among you, I will point out that this is also an extremely rare photo. This is capturing the moment, sort of like this, where the picture of the bear grabbing the salmon in the air. This is the only moment when the tail of the pup received an A from the Los Angeles County Health Department. So if you have questions, you want proof, I'll give you proof. Thank you. Thank you for coming. Okay, any comments, questions? Anybody want a card? I got a new Berkeley cards.
So what has your center done recently? What's the most recent?
We existed.
Okay.
We got a URL. That was our big accomplishment recently. I mean, really, the ink is barely dry on the. They're coming out of the woodwork. I mean, we've probably got a half. I mean, really, the website has only been up for a matter of weeks. So, I haven't moved up to Berkeley yet. I go and I give some It's faculty. We're trying to collaborate. Mostly what I've been trying to do, once I got the go-ahead from Haas, is to bring the computer scientists in. Because it's sort of astonishing to me that a lot of my finance colleagues don't know anybody in the computer science department. I found some people who taught where I went to graduate school. Christos Papadimitriou is a fabulous computer scientist. So we're rounding up people who are interested in this. We're trying to bring interesting data for people to work on real problems. So we've added a lot of faculty. I'm hoping that we'll have, Berkeley is a pretty big place. There's probably there's 600 MBAs, there's 60 what they call MFEs, Masters of Financial Engineering, and there's probably 1,000 undergraduates sort of touching finance every year.